everyone. Welcome back to the Davis at Home. We are so excited to be back. Happy New Year. We know we have been MIA for a couple of weeks, maybe, or just little bit, but sickness kind of got to us and just life just kind of took, over. But we are back and we hope you have all been staying healthy. We appreciate all our subscribers. If you are new to this channel, please be sure to subscribe to our channel. Do you want to tell them what this video is about today?
Yeah, so what we wanted to do with this video is because obviously it's a new year and people will start setting certain goals and they'll be manifesting it that 2022 is when they're going to do certain things. So if you're watching our channel, most likely you're either in the home building or purchasing process or you're looking to do it. And we wanted to kind of do a video because we have enough knowledge and been in this rodeo, as you say, a couple of times, where we wanted to just give some insight into how you can kind of prepare yourself for this process of building or purchasing a home in terms of going through the mortgage process, and give yourself a good idea of how much home will I possibly be able to afford in terms of maybe I should say mortgage payment, and then where do I stand, because these are kind of things that you can actually see yourself. You don't have to go to a mortgage lender to tell you this information. And we wanted to do this because we know when we was first building a house, and we go and ask people and say, oh, we're thinking of building a house or getting a home, and people will say like, oh, you need this, you need to do that, and they just it makes you scared. And it's kind of like an unknown thing. So we just want to kind of let people know that it doesn't have to be perfect. Majority of the time you will be able to be approved for a home. It's just a case of you need to make sure that you prepare yourself for that process.
And I know initially with our first home, I know I've probably said it before, but a friend of mine called me and she said, Pam, why don't we get a house? And I was like, oh my goodness, like this is outrageous. I always thought that you had to be super wealthy to be able to afford a home. And Ash, you had been in this country for just a little bit and didn't even have like your green card yet or something. I think he just had his work permit, and me going to him to tell him that I think we can actually do this, he was just overwhelmed. I remember you telling me that, hey, I didn't come to this country to be in debt. So, oh my gosh, this guy. So anyway, it was we know that people have a lot of misconceptions out there, and we're just here to share our little experience with you all to, think about things if you are thinking about doing it. So, people who have little knowledge that don't deter you from, accomplishing your goals or dreams of getting a home.
Okay, so when it comes to like you looking at purchasing a home or building a home, obviously you have to go through the mortgage process, unless obviously you have the funds like that to just buy the house outright. But you'll go through like this pre-approval process, right? That most people are aware of, where they're gonna check to see if you qualify for this loan and how much loan you qualify for. Once they determine that, then that's where you can go out and say, okay, I'm gonna go look at these houses and stuff around that price range. Now, something that I wish we did before is to check like where do we stand, just by checking just looking at three things. And these are three things that the mortgage lender is going to look at amongst other things. But these are things that you can actually look at yourself and get an idea. So those things is your credit score, and then your income, and then your debt to income ratio. And we'll go through all of those in a bit more detail. Now, first, we are not experts. We are not in this what do you call it, like the mortgage lending field, or realtors or anything. We're not experts. We
Yeah.
are just
We're just people who have gone through this experience and just want to share with
Yeah.
you. Just people.
Yeah, and again, like, one of our things is that we know from experience that some people, it may be your family members, it may be your friends, that when you say to them that you want to look at purchasing a house or something, they will say some things to you that you'll be like, oh my gosh, I'm not ready. Like, they will say you need 20% down, you need this, you need that, you need to be debt free, all kind of things. And it's not the case. Yes, it will be great if you do have that situation where you have the 20% and all that stuff. But if you don't, then don't let that hold you back from purchasing a home.
Yeah, in the real world, not a lot of people have all that money available and are debt free and stuff like that. So
Yeah. So if we start with the credit score. So with the credit score, of course, most people have heard of Credit Karma. So you can check on there for free to see what your credit score is at. And then if you have a credit card with, like, I don't know, Bank of America or one of those large banks, they usually have free credit score reports that you can look at, where you can get your FICO score. So that would be a good thing to look at to see where your credit score is at. Check if there's any negative reports on there, like if you have delinquent payments on there and stuff like that, then those are things that are going to give you trouble down the line in terms of getting approved for a mortgage. Now, again, we are not experts, so you talk to a lender about that, but I just know that it will give you some trouble. But something to look at with your credit score is, like, obviously what the amount is. And in terms of with the minimum credit score required for, and we'll just talk about two of the main mortgage programs, which is FHA and conventional. They have others like the USDA and the VA loans and stuff, but these are like the main ones. So the minimum score for FHA is 580 for a credit score. And then for conventional, the minimum score is 620. But the thing with conventional loan is that unless you have like 680 and above, you're not really going to get the best terms. So sometimes it makes more sense to even go with an FHA anyway. But again, you talk to a mortgage lender about that. They have that experience. They will be able to run through that with you. Another thing to think about when it comes to your credit score is to, especially if you have a spouse, and I'm laughing already. Especially if you have a spouse, is to check to check both credit score. So check your credit score and make sure your spouse check their credit score. The reason why is because if you let's say you both have excellent credit score, and you determine that you want to be on this mortgage loan together, right? So at least you can see, okay, we both have great credit score. We can go on this loan together. It's not going to be a problem. If, however, one person has excellent credit score and the other one has average credit score,
so that's the average.
That's where you need to kind of consider that, okay, is it a good idea to have both of you on the mortgage loan? The reason why is because something that I found out that I didn't know, I was naive to it, is that when the mortgage lenders are checking your credit, they check your FICO score, and they get the score from all three credit bureaus, and they take the middle number from both people. So from, if with your spouse, they will take both of your middle number. And what they will actually do is they won't take the highest middle number. So from the one that has the excellent score, they will actually take the lowest middle score number. So then that will end up meaning that you may not get the best terms with the mortgage when it comes down to that process, because they've taken the lowest.
I don't like how when you're saying low, you point this direction. Point to your direction.
Okay.
Or point to another direction.
You're being defensive, so I think I think people's already picked up on it. But so yeah, so that's where it's a good idea to check all that stuff out, so that you can be prepared for it. And then we'll we can even talk about our situation that we faced later in this video. But when you do check your credit score, because most likely it's not going to be the same FICO score model that the mortgage company is going to be using, so it may be a little off, but at least it gives you a good idea when you check like these free credit reporting, like Credit Karma and all that stuff. It gives you a good idea of where you're at. The other good thing with it is, if let's say for example, you really want to get a conventional loan and your credit score is at like, let's say, I don't know, 660. And as I said, with conventional, usually anything above 680 is where you get the best terms. So you want to use this. Usually they have like a simulator where you can put in hypotheticals that if I pay off X amount of debt, what's it going to raise my credit score to? And then it will run that, and then maybe it brings you up to, even to 700. So that's where you can, again, plan out that, okay, if I pay this off over X period of time, it's going to bring my credit score up and I'll be in a better position. So the next thing is with your income. Now, of course, I would like to hope that you know exactly how much money you make per month. So you need to look at what your gross income is. So this is before tax, before insurance and all that stuff, because the mortgage lenders, they're not taking any of that into consideration. It's only your gross monthly income that they're looking at. And figure out how much you make. And if you have your own business and all that stuff, you have to also take that in consideration and try and figure out what your gross monthly income is. The other thing to also consider that they're looking at is they want to see stability. So this is where you can reflect that, how stable am I with my job? Like, for example, if say right now I work in the IT field, and then I stay in the IT field for a year, and then I decide that I'm going to go into the restaurant industry, and then I stay there for a year, and then I move and say I'm going to go into the hospitality industry. To a mortgage lender, that's a bit of a red flag, because that's kind of like there's not much stability there. Like, you keep switching jobs, so it's like you can't make up your mind on what you're doing. So that's kind of something that you have to look at. That I think they look for. I think it's like 2 years of steady.
I think so.
Something like that. And now, something to make clear though, this is just like if you're switching into different industries. If say, I work in IT, then I change a job to a different job, still in IT, then to another one next year, still in IT, that one, they don't see that as an issue. But it's when you're like switching to different industries, that's where that can become a problem. So again, looking at your income. And then also if you decide that you're both going to go on the loan, then that's where you combine both you and your spouse's monthly income together to get the gross monthly income. So the final thing to look at and to calculate is your debt to income ratio. And basically what that is that is them looking at how much debt you owe versus the amount of gross monthly income that you're bringing in. So it's a simple way to calculate it. And there's like, I think I've seen on Wells Fargo before that they have a debt to income ratio calculator. There's plenty of resources online where you can do this, but all it simply is just your the amount of debt that you owe divided by your gross monthly income, and then that gives you your debt to income ratio. So if you take an example of like you earn 60,000 a year, just to keep the math simple, and that would be $5,000 a month gross monthly income. So remember, before tax.
So 60 divided by 12.
Right. So 5,000 gross monthly income. Then what you then need to do is look at how much debt you owe. Now, with this, what the mortgage lenders are doing that I discovered during this process that we went through with this house, is they don't actually consider all the debt. So in terms of like, well, I shouldn't say all the debt. I mean, they consider all the debt, but they don't consider all the monthly payments that you have. Mm-hmm. So like, they're not going to look at, health insurance or something like that. If you send your kids to private school, they're not going to look at, they're not going to consider your monthly school tuition that you pay for the private school. This is just going to be like your credit card, your car loan. If you have like, what do you call it?
Alimony?
Yeah, is it child support? Yeah, child
yeah.
support payments. And with the credit cards, they're not going to look at like, oh, they owe $2,000 on this credit card and they usually pay $200 every month. They're not going to look at that. What they're going to look at is what the minimum payment is. So if for that $2,000 that you owe, the minimum payment is like $60 a month, they're going to take that minimum payment. And then also they're going to look at your student loan. If you have student loan payments, they're going to take that into consideration as well. So that's where it's a good idea for you to figure out all your minimum monthly payments. If you have student loans, include that into it and then add it all together. And then what they will also do is they will take like your future mortgage payment and then include that into your debt. Once they've got that total, then that's where they will divide that by your gross monthly income to get your debt to income ratio. So if I use the example of 60,000 a year, 5,000 a month. Now let's say all your debts, it comes to $900 a month. So this is your credit card minimum payments. This is your car payment, student loan. So then now let's say that your new mortgage payment is going to be $1,200. Okay, so that's now going to bring us up to $2,100 in total debt. So then when you divide that number by 5,000, that's going to bring your debt to income ratio to 42%, which from what I've seen is a good amount. Usually they say that you should try and stay below 45%. But then that's where, again, this is to help you prepare yourself so that you know exactly where you're at. This is where you can play around with things and say, okay, so what if my mortgage payment is 1,400? What's that going to bring my debt to income ratio to? Or what if I pay off this credit card? So like you've used that simulator on Credit Karma or wherever to show if you pay off this credit card and bring it down. So now I have less debt to pay. What's that going to do to my debt to income ratio? Is that going to increase or decrease? And that's where, you can get a good idea of where you're at. And even though I said that, they usually it's best to try and stay under like maximum of 45% with debt to income ratio to get approved. I believe with FHA loan, you can get approved if you are up to like 50% or something like that. But me personally, I would say try to stay under 45%, or even 40% if you can, because remember again, they are not looking at your after-tax income. They're looking at your gross income. Like they're not looking at the money that you take home in your account. And then again, they're not looking at, they're only looking at the debt that you have on your credit score, right? So like the credit cards and the car payment and that kind of stuff. Your electricity bill, they're not looking at that. Netflix account, they're not looking at that. The grocery shopping, all that stuff. They are not looking at any of that. So only you will know exactly how much you can afford. So if you see that payment and say, okay, with a mortgage payment of $1,200 a month brings me to 42% debt to income ratio, can I afford that $1,200 a month? Like each month, can I afford it? So that's something that you really need to consider. And also remember in the back of your mind, as a reminder, that when you go through this mortgage process and you get the approval, they are going to approve you on the maximum amount for this loan. It's not going to be what you can afford. They can't tell you what you can afford. Only you can tell you what you can afford. So if they come and say that you can afford a $300,000 home, you make sure that you can afford a $300,000 home. Don't let them tell you that this is what you can afford. And then I would suggest as well that, this is another reason why it's good to look at, just preparing and giving yourself a good idea is give yourself some wiggle room. Like if they say that, let's say they say the mortgage payment that you can afford is $2,000 a month, right? Maybe look at saying, okay, I think we can afford that. It may be a little bit tight for us. Why not go for a home where you get a lower monthly payment for your mortgage, like let's say $1,500 or something, so that you can give yourself some wiggle room where maybe every now and then you can throw in some extra payments. Because when you throw in extra payments to your mortgage loan, you're throwing that directly to the principal. So when that lowers the principal balance, that can shave off years off of the life of that mortgage. So that's something to also consider. So we're gonna pause here for now because we didn't want this video to be too long. I think it's still even longer than what we wanted it to be. But just to recap, so we basically gone over like 3 of the main things that you can look at to kind of help yourself be prepared and give yourself a good idea of where you're at before jumping into this journey of going through the mortgage process and everything. So that's looking at your credit, your income, and calculating your debt to income ratio. and I think it's a good way to kind of figure out where you're at, so that you are more empowered to know what you can afford versus the lender telling you that, oh, you can afford this.
So we'll be back next week with our experiences from our experience with this mortgage, as well as our previous experience with our old house. I know Ash probably is eager to tell you all bad stuff about me. But anyway, we'll be back next week to share it with you all, because I know that when we were going through the mortgage process, it almost gave him panic attacks and he was just going crazy. But yeah, we'll be back next week. Please be sure to subscribe to our channel. We really appreciate you all. Thanks for sticking with us. And so have a good rest of your week. Talk to you next week. Bye.